Good afternoon, ladies and gentlemen, and welcome to today's webinar with Minnett. It's a pleasure to be joined here by Simon Kent-Jones, our Head of Private Client Research. I'm Malcolm Wood, Head of Asset Allocation and Philanthropic Services. Today we've titled the presentation, Trump Rubber Hits the Road, and we're now 7-8 months into the second Trump administration, and that's a key investment theme for us. We'll analyse the impact of the Trump 2 agenda. Then we'll go and look at the implications of that for the Federal Reserve, do an analysis of the outlook for interest rates here, then turn to China, where we think there's a domestic downturn has begun, and then come back to that very important issue for us as investors, which is valuation. With stretched valuations in Australia and the United States, and come to some investment conclusions on the back of all that. If you have any questions, please throw them into the Q&A section at the bottom of your screen, and we'll deal with those when we get to the end. So let's jump right into it. And first of all, set a little bit of context for how we're looking, both economically and in markets. Economically, a couple of years ago, investors were talking a lot about US exceptionalism. That's the blue line on the left chart. US growth was much higher than other major economies. What's happened since then is there's been some convergence. So US growing 2.1%, we're at 1.8%. Most other major economies in that 1 and 1.5 range. So growth converged. Even with that, unemployment remains low. It's inched up in the US, about flat year on year here, and at very low levels in Europe and Japan. On the right side, the story of the last few years was all about inflation, the surge of inflation coming out of COVID, then the disinflation as things normalised and central banks lifted rates, but in the last year or so, that improvement in the inflation outlook has largely stalled. So that's the economic backdrop. Let's come to the market backdrop. And despite that slowdown in disinflation or inflation going sideways, central banks have been easing rates. And of course, last night we had the US Federal Reserve resume its easing cycle. So that's an ongoing thematic. Turning to markets, if you look at the chart on the left there, bond yields have moved largely sideways, really for 3 years now, coming out of that big sell-off or rise in yields that we saw coming out of COVID. I'd just highlight that very recently we've started to see a divergence between, say, the US, which is the dark blue line, and the UK, which is that light line at the top of the screen. So we're getting a little bit of stress in bond markets in, say, France and in the UK. Turn to the right side, our equity markets have been unaffected by any of these issues, and we saw that rapid rebound out of the Trump, after the Trump Liberation Day sell-off in April, and we're at or around record highs in global markets. So that's the market backdrop. So let's jump right into this first theme about the implications of the Trump agenda. The first point to make here is, in our view, the Trump 2 agenda is far more significant and far more reaching than the Trump 1 presidency. Let me give you a few examples of that. Look at the chart on the left. Back in 2016, there was all this angst about the wall, but the number of illegal immigrants back then was small compared to what occurred under the Biden administration, and now essentially that's been stopped. So border encounters down almost 100% year on year. Now, this is important because roughly 2 million people a year were coming across the border, and we've had, in addition to that, about 1 million people self-deport. So we think this is a significant change in the labour supply in the United States, a point highlighted by Chairman Powell last night in the Fed press conference. Secondly, let's have a look at government spending. There was much made about Doge, or I call it dodgy, with Elon Musk early in the year. Musk is long gone, but the spending cuts remain. If you look at the chart on the right, federal spending in the last 7 months, or the first seven months of Trump 2, is up just 1.4% in nominal terms, so declining in real terms. That contrasts with the Biden administration, where spending rose at an underlying pace of about 9%, and Trump 1 pre-COVID, where spending rose about 5%. So the spending cuts are real, in our opinion. Come to the tax cuts. This is probably one area where things are less significant than Trump 1. So we've had the one big beautiful tax bill passed by Congress around Independence Day. Big headline cost, but the vast majority of that is an extension of the Trump tax cuts coming out of 2017. So in our view, what you're looking at is stimulus, yes, but at a sort of healthy pace, not the big stimulus of 2017. And then to come to the big one, tariffs. Already the US Treasury's garnering an incremental, an additional $270 billion in revenues in August at an annual rate. So we think that this is significant, but a lot more to come. And I'm going to come on to that now and say a couple of things about these tariffs. Markets have got very complacent about this. We think this is a significant event. If you look at the chart on the left, the jump in the US effective tariff rate puts it at the highest levels in 90 years. So it's not something most people have ever seen. If we look at the way markets have treated that, looking at the chart on the right, you can see that we entered 2025 with an effective US tariff rate of about 2%. It jumped much higher on Liberation Day, and then to a peak in that tit-for-tat retaliation phase with China. Then it settled down with the pauses. And yet what we're looking at here is a tariff rate that is much higher than earlier in the year. But look at the market reaction. Aside from that sell-off around Liberation Day, markets have been quite unaffected by the tariffs. But as we say, we think this is substantial. Already, the US is raising an incremental $270 billion in tariff revenue. But before substitution effects, we think that this tariff is actually about 2 times that run rate. So when we add all those factors up together, just to go back a slide, what we're looking at is an effective tightening of policy in the United States of something in the range of 1.5% to 2% of GDP. That's something we have not seen in my career. The last significant tightening of policy in the US was really under Bill Clinton, which is, again, 30 years ago. It also has other global implications beyond the tariff impact. Security has been reshaped globally with NATO, particularly the European members, stepping up their defence commitments, and we're probably seeing a bit of a step up in defence commitments from Australia this week. And beyond that, we've seen governments respond in further ways to the Trump administration. So the first point is we think the Trump agenda is significant. It's far more far-reaching than Trump 1, and it's really starting to impact now with further impacts over the next few months, in our view, as the tariffs roll through. So how's the Federal Reserve dealing with this? And of course, last night the Fed cut rates. We think the Fed is in a very tricky, challenging environment. On the one side, you've got the labour market slowing. So the chart on the left, which is one that Chairman Powell used when he presented that shift in Fed bias at the Jackson Hole conference. You can see the blue line, employment growth moderating. In fact, employment as last measured is up at about 30,000 a month. This is very small growth in employment in the United States at this point in time. Now, in normal circumstances, that would have been associated with a big jump in unemployment. But you look at the black line on that chart, unemployment's actually just 0.1 percentage point higher on a year ago. So what's happened here is that you've had a significant slowdown in labour supply, courtesy of the Trump administration's migration policies. So what we're seeing is both a demand moderation and a supply moderation. The Fed taking the view that this is a more significant demand issue at this point in time. So the Fed has started cutting rates again. I want to put that in an inflationary context, looking at the chart on the right. If you look at those data points I've got on the chart, you have to go way back to the early 90s to see that a Fed actually cutting rates with inflation above its 2% target. So this is the first time in at least 30 years that the Fed has done that. It did it last September. It's doing it now. Inflation is above the target. So the Fed does seem to be putting more emphasis on employment than on inflation fighting in trying to manage those two objectives. Now, this has significance for the transmission of Fed policy. And you particularly need to understand that the way policy operates through the economy in the United States is a bit different to here. In Australia, the Reserve Bank cuts rates. We're all setting the stopwatch to see how long it is before the mortgage rate declines. In the United States, Fed policy does not impact the mortgage rate. The mortgage rate is set by the bond market. And so the interesting thing about this Fed easing cycle is that the bond market has not cooperated. So if you look at the chart on the left, the bond market is reactions in different Fed easing cycles over the last 40 years. The current cycle is the thick blue line. And if we update for last night, in this cycle, bond yields have actually risen despite the Fed rate cuts of 125 basis points. The bond yield is actually up 45 basis points. We see this particularly in the housing market. Last night we had another soft housing starts number in the United States, and it's a reflection of the impact of those much higher mortgage rates in that 6.5 range that we've seen. So we think that the Fed is facing a bit of a challenge here. It might be okay for the Fed to ease policy, but the economic impact will be muted if they don't get the bond yield down materially. So that's the US, a bit of a juggling act for the Fed, and one that we think the market is quite complacent about. Let's come to Australia, where we have seen 3 rate cuts from the Reserve Bank. We think we're pretty close to done on that. Why is that? Well, it's because growth in Australia has responded to the easing of policy by the Reserve Bank. If you want to put that in some context, compared to the United States, we have easy fiscal policy. Under Trump, the US has tight fiscal policy, and the evidence of the impact of the Reserve Bank easings is far stronger than in the US. To give you an example, look at the chart on the left. Household consumer sentiment, the blue line on that chart, has clearly come off the lows. It was very depressed, as you can see. It's just below long-term average levels now. And we've seen that lift also in retail sales and household expenditure measures. So activity in Australia has picked up. GDP in the second quarter was 1.8% year on year. That's significant because that is roughly in line with underlying labour force growth or population growth in Australia. And that is significant because we don't have any productivity growth at the moment. So it's quite conceivable here that with the 3 Reserve Bank rate cuts, that Australian growth is now actually running above potential. Now, that's significant when you come to think about inflation, because Australia has a tight labour market, even with the employment numbers softer today as measured. Unemployment is roughly flat year on year in Australia at 4.2%, and underemployment, which is the red line on that right chart, fell to a 24-year low, 5.7%. So it's not clear to us that we're going to see any further easing of labour cost pressures here in Australia. So growth's picked up, labour market remains tight. For the Reserve Bank to look to cut rates, we think one of two things needs to happen. Either on the left, we see the labour market soften. We don't expect that, but it's possible. We saw a softer headline employment number today, which could mean that that black line on that left chart eases services inflation. The other possibility would be some sort of exogenous effect, and we're going to come back and talk about China in a moment. So what do we think about these two themes and the investment implications of them? If the Trump administration is all about tightening fiscal policy in the United States, putting downward pressure on US growth, that's one reason to look to own bonds. In another sense, if the Fed's struggling to get traction, that also reinforces the view in our mind that bonds are a place to consider investing. So we've been adding to our bond position and to long-term government bond position. There's that reason for it. The other reason is relative valuation. We're going to come back and talk about equity market valuation in a minute, but compared to equities, which is that chart on the right, when those two lines are high, bonds are expensive relative to equities. But at the moment, we're at 20-25-year lows in terms of that relative valuation. So we think relative valuation, the diversification benefits, and some of the implications of that Trump policy agenda suggest to us it's time to own some government bonds. So that's the second theme. Let's jump on to the China story, which we think is really at a very interesting juncture. First point to make about the China story is that it's in deflation, which means the blue line on the left chart, that's nominal GDP growth, is below the black line, real GDP growth. Now, real GDP is just talking about the volumes in an economy. Economists like to talk about that. But ladies and gentlemen, you pay the bills with nominal growth. That's the blue line. And that, outside of the COVID lockdowns, is at the lowest level on record in China at 3.9% year on year. That was the second quarter. Since then, the story's got worse in China. We've had now a third consecutive decline in investment. The red line on the right chart is year-to-date investment. But if you dig beneath that, the August investment number on our analysis is down about 7% year on year. Now, outside of that COVID lockdown, this has never happened before in modern China. In addition to that, we are not seeing the consumer drive the economy. Retail sales, after a bit of an improvement on the back of a cash to clunkers sort of trade-in stimulus, is now started to roll over as well. And imports remain sluggish. So you've got this picture here of weak domestic demand in China. Now, what's bringing all this about and what are the investment implications of it? Let's have a look at what's bringing it about. We think it's a combination of four factors. The first one is the structural challenges that China faces. Let me give you an example. China has taken on way too much debt in our view. The red line on that left chart there exemplifies this. Really, since the GFC, but particularly under President Xi, you've seen debt explode in China. That's the red line again, 380% under President Xi. GDP growth has continued, so the debt has lifted growth, but that's the black line on that chart, up about 150% over that same 13-year period. But then when you come to the outcome of all that debt, which is the profits growth, that's where it gets really challenging, because the blue line on that same chart, industrial profits growth, it's not the whole story in China, but it's an interesting indicator, is basically up 30% on the level from when President Xi came to power. So we think what we've got here is an example of too much debt, too much capacity, overinvestment in many, many parts of the economy, overbuilding, and that's leading to downward pressure on prices and profits. And that's a big part of the problem in China. We think it's a bit of a massive misallocation of capital. On top of that, a year ago, China announced a significant coordinated stimulus package. And here we are a year later, and I'm explaining to you that things are getting worse. And then finally, we think the catalyst for this could be the Trump trade war, which is putting additional pressure on the China economy. Now, of course, this is not a story that you've heard on the 7 o'clock news, and we think it's really one that should be getting a lot more attention. So why isn't that? Well, some of it is because there's a bull argument saying that actually China's all good, don't worry about it. Let me deal with a couple of those bull arguments. The first one is that there's a stealth stimulus happening in China, and you can see that if you look at money supply growth, which is the red line on the right chart. You can see there that from record levels a year ago, money supply growth has picked up. Good news. And in prior cycles, that's been a good indicator of a surge in loan growth. However, in this cycle, what we've seen is loan growth continue to decelerate, and in the August data, it fell to a new record low of 6.8% year on year. Now, Keynes had a description for this in the Great Depression. He called it pushing on a string. Policymakers can get to a point where they are attempting to stimulate the economy, but it has no effect. Second argument for China is that China has been able to deal with the US trade war very effectively by redirecting exports from the US to other markets. And there's truth to that. Exports in August were up 4% year on year in China, with US exports to the US down 33%. So where are all those exports going? Some to Europe, but most of it is going to emerging markets. And they now account for more than half of China's overall exports. Now, the problem in our view with that is it's probably something akin to dumping. So you're losing a profitable export market in the US and replacing that with a much less profitable emerging markets. So our view is that that could be causing the cash flow implications, driving some of this pullback in investment. The other two arguments for China are that they will do whatever it takes. The policymakers are really good there. And I think that's a bit backward looking. And our central case scenario out of this is that China is falling into a Japan-style deflation, and the implications of that are still to come. So let's come to the fourth theme, which is all about valuation. And what we're seeing is particularly extended valuations in the United States and Australia. Let's just deal with that. First point is these are unusually stretched valuations. So the US on the left here, the black line is the forward PE, almost 23 times. That's unusual. Really, in the last 150 years, we've only been more expensive once, which was the internet.com boom of 25 years ago. And you can see that that didn't last. Now, the arguments for these extended valuations revolve around US exceptionalism. As I said at the start, that if anything seems to have weakened since that argument first emerged a couple of years ago with the US rest of world growth gap narrowing. The other argument is all around the quality of US technology leadership, particularly the Magnificent Seven stocks. We've tried to capture that with this chart on the right. These companies are still growing at a double-digit clip, the black line, and profits and profit margins have risen to record levels. Now, we think there's certainly some truth to that, as there was back in the internet boom, which, of course, ended up disappointing from a market's perspective, despite the fact that we all ended up using the internet and having a mobile smartphone. So we think that this is something to watch very carefully and treat carefully. Now, when you compare the US to the rest of the world, it's rarely been more expensive in our view, with the chart on the left, bottom left to top right. So US market trading at about a 50% premium to the rest of the world. Again, saying there may be the best companies, but that is at least somewhat recognised by markets. So we think that there's better opportunities outside the United States. And we'd be very much of the view that markets like Japan and emerging markets ex-China represent a better opportunity for investors. How about here in Australia? How do we stack up on that basis? Well, if anything, Australia is more expensive than the United States, with the added problem that we don't have any Magnificent Seven companies and we're highly exposed to China risks, something like 15, 20 times more exposed than the United States. So we think that that is a concern for Australia, not recognised in valuations here. If you look at the chart on the right, the black line is the forward PE in Australia, sitting at around 20 times, pretty close to a record high. If you strip out the resources sector, it gets more expensive. If you strip out the banks, even though the banks are very expensive by historic standards, it gets even further expensive. Now, to compare us to the United States, you might say, well, Mal, you're talking about 20 times here, 23 times in the United States, we're cheaper. However, that's a bit of an optical illusion, because if you do a like-for-like sector comparison, as we do here on the table on the left, our market on US weightings is actually 25% more expensive than the US. So we don't really see the value here. So what's going on if it's a lot of hype around the Magnificent Seven and US tech leadership in the US market? What's the story that's driving our extended valuations? It's not a fundamental story, it's a flow story. Now, we're all familiar with our superannuation industry, which is growing rapidly. That's the chart on the left. The blue and black lines, bottom left to top right, as the superannuation industry is growing in size and scale, certainly much larger now than the economy in our stock market. And with the recent increases in the super guarantee levy, the flows, the blue bars in that chart, have also picked up. So there's certainly truth to the argument that there's more flow coming into the market from the superannuation industry. On top of that, the industry funds, who are the 640-pound gorillas in the superannuation industry, they've been increasing their exposure to growth assets like Australian equities. Does that mean this is a good investment? No, we think that it is today, more than ever, the superannuation industry has the ability to go anywhere in the world. So we're unconvinced that this will be a persistent valuation distortion. I just wanted to highlight before we finish on this theme that the banks, even with the sell-off that we've seen in CBA on the right there, still remain very expensive by historic standards. So where should we as investors look? Where are the opportunities? What should we be doing about all this? Well, our advice would be to participate with care. What do we mean by that? Well, it's not a case of having zero in Australian equities and US equities, but it is a case of being below your normal allocation. What should you be doing with that money? Some of it we think you could consider putting into small caps. The black line on the left chart is the Australian small caps compared to the large caps. On the cheap side, the red line is the US, same thing, very cheap. The cheapest since the GFC and the TMT bubble, respectively. These small caps tend to do better when central banks are cutting rates. And thirdly, if you look at the very left of that chart, when we had the bust coming out of the dot-com boom 25 years ago, small caps did outperform. So we think there's a case for small caps. We added some exposure there a couple of months ago. We've talked about bonds, where we've added duration over the course of the last 6-12 months. And then thirdly, the other area which we think looks interesting is global property and infrastructure, trading at a major valuation discount. You can see that on the chart on the right, which is global property compared to global markets. And in many instances at a discount to replacement value. Again, a more defensive sector that should perform well in a difficult market if some of our themes come to fruition. So summarising, ladies and gentlemen, we think that it's a time to remain on the cautious side. We are generally underweight equities, particularly Australian large cap and US global equities. We do think there are pockets of opportunity, however. So participate with care in small caps, in emerging markets ex-China, in some alternatives, in government bonds. That would be some of the areas that we would recommend. Now, I wanted to highlight the portfolios that I'm responsible for managing, our balanced and multi-asset fund and high growth funds, just to highlight the importance of diversification. See how many blue boxes we've got across different asset classes, which is all the red boxes in this chart. So now is the time, in our view, not to just own Australian equities. If you've been fortunate enough to do that, you've had a great run. As we said, valuation is extremely expensive without the fundamental story to accompany it. Likewise, for the high growth investor, a more aggressive investor, we think it's time to be a little on the cautious side. So we've got some alternatives, some real assets and in that portfolio, and fixed income in that portfolio more than we normally would have. We've been able to keep up with markets despite this more cautious outlook over the last year or so. So let's wrap it up, ladies and gentlemen, and turn it over for Q&A. We are into really where the Trump agenda hits the road. We do think that investors do not appreciate how significant the tightening of policy has been under Trump 2. This says to us there's downside risk to US growth. And with the Fed cutting rates but not getting traction on bond yields, that also adds to our concern. Hence, an argument to be a little bit more cautious. Come to Australia and growth has picked up. Reserve Bank policy has worked. We think that we're probably at or above potential. We've got a tight labour market. The inflation story could remain challenging, an argument to remain cautious here. Turn to China, where we think a domestic downturn has begun. Structural challenges, poor capital allocation, the trade war, all intensifying pressure on China policymakers who at this point seem to be deers in the headlights. So that's a risk for China directly, but also for Australia indirectly. And this all happening in an environment of extreme valuations, particularly in the US and Australian equity markets. Again, an argument for caution, but we think it's an argument that we should be participating with care in markets. Areas where we see opportunities include small caps, long-term bonds, and global property and infrastructure. So let's stop there and see if we've got any questions and open it up with Simon. Thank you.
Great. Thanks, Mal. First question is around the currencies. So we've seen a softening in the US dollar, obviously. Yes. FOMC last night cutting rates. That obviously supports a weaker dollar. But if you can frame that with the Australian dollar, Aussies had some strength, but obviously on that China domestic downturn, there are some concerns or some potential headwinds for the currency here. What are your thoughts?
Yeah. So at this point in time, we think that the Aussie dollar is not a great way to play a US easing cycle because of that China risk. So we'd be more inclined to own euros or yen, alternate third currencies. Let's just run through the drivers of the Australian dollar. Historically, commodity prices important, although they've become less important as the mining industry is not reinvested in Australia. We see downside risk to commodities that are particularly exposed to China on this downturn theory. And in that scenario, we don't think Australian interest rates are going to be higher or materially higher than the US. So it's true that our currency is on the cheaper side, but the logical drivers of it in our mind are just not there. So we remain unhedged in our international equity exposures because of that view.
Okay. We've been on the road with this roadshow for a couple of weeks now. One of the consistent questions has been around the strength in the gold price, potential positioning of gold within portfolios. Do you have some thoughts around gold price, whether it can continue to move higher, especially given the geopolitical concerns around inflation, especially in the US?
Yeah. No, and I think they're two good drivers of the gold price really since the Russia invasion of Ukraine and the West confiscating some of the foreign exchange reserves of Russia. There's been very little, there's been no incentive for many countries who could possibly be adversaries to the West owning treasuries, US treasuries, or any Western currency for that matter. So they've been buying. So central bank buying of gold has been very, very strong. I think the concerns about issues in China mean that there's probably quite a bit of domestic China purchases of gold happening. Someone telling me today that the gold price in China trades at a significant premium to the global price. So they're the drivers of the gold price. So if you believe that the US is going to continue to be a bit soft on inflation, and that will lead people to be concerned about the outlook for fiat currency. Secondly, the geopolitical issues, if you think they will persist, that is a positive for the gold price. Having said all that, we all need to realise that the gold price is at a record level in real terms. Obviously, it's at a record level in nominal terms, but inflation adjusted, we're well above 1980 levels. In addition, compared to other commodities like oil or copper, we're at or around record highs on that metric as well. So the gold price is expensive. Yes, there is an argument for it, but it's expensive. And so I think it needs to be treated a little bit like some of those US M7 names, great businesses, but they're expensive. A lot of good news is in the price. So we'd certainly would not be advocating a big position in gold at this point.
A question which I can probably answer just around reporting season and what are some of the themes that we see coming out of that in terms of sectors. So the Australian market during the reporting season actually had some real strength. The market was up 3.1% on an accumulation basis. To your point, Mal, earlier about small caps. Small caps had an outstanding month in August. They were up around about 8%, and that was both small cap resources and small industrials. So in terms of some of the sector ideas coming out of it, healthcare sector or parts of the healthcare sector look compelling. The market expecting some robust sectoral earnings growth. Of course, there were some disappointments. CSL prominent amongst that, but one of the key stocks that we'd recommend coming out of reporting season was ResMed. The outlook there looks very strong. Telcos certainly offer some defensiveness, mostly insulated from tariffs, and one of the outstanding results was from Aussie Broadband. Selected industrials screened as attractive. One of the better results during reporting season was Brambles. We still continue to like that stock. Financials, this has certainly been topical for some time. They still screen expensive. Earnings momentum is slowing as net interest margins have peaked. Our key pick amongst the large caps would be NAB, just in terms of valuation and potential return. Obviously, take a close look at ANZ, new CEO shaking things up there. They've obviously been hit with some significant fines this week. But looking beyond that, there's certainly some potential opportunity there. Insurers, they're seeing some moderation in premium growth. Margins have held. Claims inflation is also falling. Our preference really there is some of the insurance broking stocks, Steadfast, AUB. Real estate outlook is improving. We actually heard in our morning meeting this morning from the real estate analyst some evidence of a recovery underway in office. Retail is going great guns. So some of the key large cap stocks there, Vicinity, Scentre Group and GPT. Technology valuation certainly looks stretched. If you have a look at that table that Mal showed in one of his earlier slides, the PE ratio for the Australian tech sector looks like it's sitting in nosebleed territory. But nonetheless, there's strong earnings growth expected over FY25, 26 and 27. Some key ideas there include Qoria in the small cap space, and then some of the traditional tech stocks like Xero certainly look attractive as well. Resources is mixed. Gold and copper miners are faring better. Bulk commodities remained under pressure, particularly iron ore. Mal spoke about the concerns around China, and I think one of the reasons why we're seeing less mining investment here in Australia is that the major miners are trying to diversify away from iron ore into things like copper, and so that's where we'd lean. Energy stocks screen undervalued. Obviously, news this morning that bid for Santos has been removed. The stock's down sharply as a result, but there's certainly some uncertainty around the outlook for energy markets. Those supply dynamics and question marks on global growth may continue to dampen the outlook for oil prices. And then finally, just on consumer stocks, largely positive. Period of rising inflation, tax cuts and lower interest rates should support real household incomes. Bodes well for discretionary. Staples provide some defensiveness. Woolworths was another major stock that hit an air pocket. It fell significantly on its result. Where it currently sits, our preference would be Coles over Woolworths. We think Woolworths has got a fair bit of work to do to regain its position relative to Coles, which after a significant period of investment in logistics operations really seems to be getting a return on that investment. Okay, so turning to other questions. Just in terms of another question that seems to have popped up, I suppose it's especially around stretched valuations and a concern that perhaps we're seeing the potential repeat of global financial crisis. What are your thoughts on the likelihood of that occurring?
Yes, I think it's correct to say that equity valuations are stretched, but really the nature of the banking system, the financial system has changed. So the banks are far better capitalised, and Simon, you can probably add to this, far better capitalised than they were pre-global financial crisis. The regulatory environment has tightened quite a bit, and the bank's risk profile has come down. Now, you might argue that some of that riskier part of the bank business has been taken off balance sheet and is now in what we call the private credit markets, and that some of the riskier investments are happening there. And we'd certainly be saying to clients to be very careful about aggressively pursuing private credit investments at this point in time without doing quite a bit of due diligence on the underlying investments of the manager and the manager's credentials. So that would be, I guess you'd say, now a more indirect risk to the system, Simon, in that you don't have that sort of leverage that you had with the banks, and there's a lot more capital behind the banks than before. Now, it's definitely true that government debt has gone up since the GFC. So a lot of those problems that we had in the GFC ended up getting taken, if you will, by the government sector. And then there was all the stimulus to get the economy going again. So we certainly have a lot more government debt now than pre-global financial crisis. But take the US as an example. The household sector debt level, or it's close to like 25, 30-year lows, and corporate debt levels as a whole are pretty good. And I think we were saying the other day that corporate leverage in Australia is actually pretty good. So to sort of answer that question, you'd say unlikely that we would have a financial crisis like the GFC. There are pockets of risk. One would be that private credit space. Another would be governments that have taken on a lot of debt, particularly, say, the US, where there's some issues around that. And then I mentioned earlier the UK and France as examples. And then, of course, the big one outside of that Western financial system is China, where we say there's a lot of debt. But the good news is that's virtually all owned internally at this point in time.
I suppose one of the features of the Trump administration is a desire to influence the decision making at the Fed. Can you just talk about any concerns around the independence of the Fed? We obviously had the FOMC meeting. You know, it clearly looked as though that was an independent decision. But is that something that bond markets are concerned about at the moment? Could that develop into some kind of problem?
And I think that's a really good question. You know, we're going to see highly likely to see a new Fed chairperson next year. We had a Trump appointee onto the Fed participate in his first meeting, and he advocated for a 50 basis point rate cut. So there are potential risks at the side. When Chairman Powell was asked this question last night, he said that the culture of the Fed is very independent. Of course, the Fed's been in existence for over 112 years. And you've got sort of a very data process-driven culture. And he contrasted it with the rest of DC, which he said was thought politics first and fundamentals afterwards. So I guess he was trying to say the Fed's different. So it's a risk. And, you know, there's good reasons why Australia moved toward an independent central bank, 30 years ago, because political interference often produces suboptimal outcomes. So if the US goes that way, it would be, I think, regrettable. So hopefully we avoid that. Now, if you looked at bond markets and said, well, okay, so Mal, you said that bond yields have risen despite the Fed cutting rates. You could say there's a little bit of concern about that already in markets. It could also come back to that government debt issue we were just talking about. And it could also come from central banks now thinking more about their dual mandates. So this is employment or full employment and inflation, not just inflation as they did in the past. But whatever it is, some combination of those, it seems that the bond market is a little bit cautious. So that is a risk here, Simon.
Okay, great. Thanks, Mel. Now, one thing that I should point out, in our travels, we've been traveling a little bit with Andrew Gordon, who's our head of debt capital markets, and also Justin McCarthy, who sits on his team as well. And there's we have a discussion around bonds and the bond service that we're able to provide to clients. And so I just want to note that, and also, really what we're talking about is debt that's issued by a lot of the companies that a lot of our clients hold the ordinary equity in. So, for example, this week, a couple of deals are being issued by AGL Energy, IAG as well, ANZ recently. So, these are certainly something that we're finding is getting a lot of traction with clients through our advisor base, and especially in light of the fact that APRA has decided to wind back the listed hybrid securities market, and so this is a good opportunity to invest in an interest rate security, pays a regular distribution flow through to investors. So I just want to raise that and certainly have a chat to your advisor here at Ords about that. Just checking to see any final questions. There's one here with international equities. Which countries would you prefer over the US? Japan, India, Europe?
Yeah. So we saw we've actually seen some good relative performance from both Japan and Europe over the last year or so. Good performance from Japan when you consider that they are quite export dependent on the US. And I think that's to do with the fact that Japan is relatively cheap and the yen is particularly competitive at current levels. If any of you have been on a trip to Japan, you'd sort of say that, yes, it definitely is competitive currency. So Japan's done well. We still think Japan looks okay, but it certainly has already performed well. Europe certainly did very well coming out of that shift toward more German stimulus and an increase in defence spending. And I know Simon's been onto the defence theme with a particularly European focus as a way to play that. And again, Europe has re-rated somewhat. So we do think they are a lot lower risk than the US market at this point in time. And some of the global multinationals in Europe we think are relatively attractively priced. India's a little trickier. India is never cheap. It seems to be, from a geopolitical side, hedging its bets. Of course, the US and India sort of seem to have had some sparks, but it appears that they're trying to mend those fences as well. But you would have thought that India would be a logical place to win from US business shifting out of China. But whether that's under a little bit of a cloud now remains to be seen. So I think it's important to be selective in your exposure into India. So we do think that emerging markets that will win the shift of US business away from China, particularly the likes of Mexico, Brazil, should do better as well. So yes, we think ex-US looks better. And we prefer some of those emerging markets ex-China.
Okay, one question here. What do we think of renewable energy investment?
Well, that's a big one. So what you're seeing here and internationally is a big shift toward renewables. That's a well-established theme. What we can say is that it's getting trickier. The US under President Trump has sort of backtracked on its move toward renewables. And I think the One Big Beautiful Tax Bill ends a lot of the tax incentives that were put in place under President Biden. Then you've also got the increase in tariff barriers. China exporting renewable energy products into the United States, I think quite problematic at this point, probably even problematic into many parts of Europe. So it does seem to us to be a more difficult environment for renewables investment from a high level. Simon, I know you spend a bit of time thinking about this as well. Any thoughts to add on that?
Yeah, look, it is difficult, and I suppose the problem is one of the problems is, and the Labor government is certainly discussing this at the moment as they roll out their emissions targets. That the actual rollout has been far more expensive than had been originally planned. That there's a number of reasons for that. Post-COVID supply chains, all of those sorts of things. There's a bit of crowding out from just a wave of investment that's gone into this space. Labour costs have gone up because there's all these other construction projects, infrastructure projects, and then I think the problem as well is getting community buy-in for some of these projects. There seems to be a real resistance there, so it's certainly challenging commercially to do it. That said, there are companies that are progressing with it. I mentioned before AGL Energy. AGL's actually got the largest renewable set here in a renewable energy set here in Australia, and they continue to invest in that. But of course, at the other end of the scale, they've got coal-fired power stations. So there's a certain balance there. The progression of renewable energy will continue. Obviously, the Labor government is committed to that, but it certainly faces some headwinds. So I think from an investment point of view, it's certainly a challenging environment at this particular point. Now, just checking to see if we've... Now, David's got a question about a particular stock. David, I'll respond to you directly on that, and then just checking to see if we've got any further questions. And then Mal, just following up, you mentioned some defence exposure. There's one particular ETF that we've held in our international equities portfolio for some time, and that's called the Global X Defence Tech ETF. Bit of a mouthful, but all you need to remember is the code DTEC, DTEC, and then you should be able to see what that's comprised of. But as Mal said, a fair bit of European exposure. You've also got a bit of US exposure, but less perhaps to the US primes, the Raytheons and the like, but some of the other exposures there in the US. I know we're coming up to time, and I think we've exhausted the questions. So perhaps if you just want to have a closing remark.
Yeah, no, I think these are tricky times for us as fundamental investors. Markets, particularly US and Australia, look expensive. They do seem to us to be not fully pricing in or discounting some of the risks out there from the Trump agenda, from sticky inflation, from China economic imbalances. So we think it's time to participate with care, and we just again highlight some of those things that we've talked about, whether it be small caps, buying bonds or fixed income exposure. As Simon said, good thing to have a chat to your advisor about, whether it be global property infrastructure, sort of more defensive growth assets, ways to deal with this environment. Just one other point to remind you is that this presentation has been recorded, and I know that the team will be sending out a copy of the slides for your perusal. So thank you very much, ladies and gentlemen. It's been a pleasure to present to you again.
Great. Thanks, Mel. Thanks, everyone.